Hello, I'm Russ Mould, AJ Bell's Investment Director, and welcome to the latest edition of Fundamentals, where I'll be looking at the third best-selling fund on the AJ Bell Invest Centre platform at the moment, namely BlackRock Corporate Bond 1 to 10 year. The £887 million fund seeks to provide a total return via a combination of capital growth and income by investing in fixed income securities, bonds, issued by corporations. It seeks to do this by closely tracking the performance of a composite benchmark, itself the product of two separate indices. The first is the Bank of America Merrill Lynch Sterling Corporate Securities 1 to 5 year index, and the second is the BAML Sterling Corporate Securities 5 to 10 year index. As a result, the portfolio of bonds is a wide one. It's got 401 holdings, and the top 10 positions represent barely 8% of the assets under management. And they include debt issued by Barclays, Imperial Brands and Lloyds Bank, as well as global brewer Anheuser-Busch and American bank Wells Fargo. The yield at the moment is around the 3.4% mark, and as the name suggests, the fund is designed to have a relatively short duration. As I sit here, the effective duration is 4.7 years and the effective maturity 9.9. The chart here shows the maturity range of the holdings ranked by year. The next graphic shows the mix of credit quality through the portfolio. It's really not surprising that there's very little AAA rated paper here, as there are so few companies who now have that coveted top rating. However, the bulk's rated between A and BBB, in other words investment grade, with barely 9% of the holdings assessed as sub-investment grade, high yield or junk, or for that matter unrated. This credit quality mix is reflected in the coupon profile across the fund, with the vast majority of the holdings offering coupons of between 0 and 6%. This version of the collective comes with accumulation units, so the income generated is reinvested on a semi-annual basis, and the ongoing charge figure is a pleasingly low 0.17%. So those are the mechanics. The question is why advisors and clients are buying right now, and I think there are four possible explanations. First, that yield of 3.4% will be more than satisfactory to some income hunters. Second, interest rates on cash remain anchored at rock bottom levels, and yields on sovereign or government paper are heading deeper into negative territory in many cases. Negative interest rate policies, NIRP for short, are in many ways forcing advisors and clients toward corporate bonds whether they like it or not, if they're looking for yield and don't wish to embrace equities too wholeheartedly. Third, the short duration of the fund may appeal to some, given it leaves clients in the collective less exposed to capital loss in the event interest rates start to go up at some stage, or certainly that's the theory. Duration measures how much a bond's price will change relative to a 1% change in interest rates, and in general, long duration or high yield bonds are the most sensitive instruments to rate changes, short duration and low yield bonds the least. And fourth and finally, the European Central Bank has started buying corporate debt as part of its quantitative easing or QE scheme. This is creating some positive price momentum in corporate bonds as a seemingly price insensitive buyer gets involved in the market. Now, this isn't to say the fund will be totally immune to any wobbles if the Federal Reserve or any other central bank ever gets around to hiking headline borrowing costs, or for that matter, if the European Central Bank ever turns seller of corporate paper. But it may offer a little more protection than those funds which have heavy weightings toward debt that's got a lifespan of 10 years or more. Some advisors and clients may just take the view that bonds are little more than return-free risk, given the yield compression we've seen in a world where low interest rates and QE dominate. If this is their view, they'll probably avoid this fixed income collective as they would any other. But judging by fund flows, some seem to be taking the view that some exposure is still desirable to corporate debt, and this collective may be one way of managing interest rate risk while seeking out some income. So thank you for watching, and I look forward to seeing you next time.